Hey guys, welcome to this channel. In this video I'm going to be walking you down to a strategy, an indicator that is known as a moving average. I'm going to be explaining it down to the bottom of everything you need to know about moving average. Now let's first of all understand what moving average is all about. It's an indicator that is commonly used in technical analysis. Now take note, technical analysis is not actually what fundamental, and it is used to help in smooth out price data, that is information that is being happening in the market, and also by creating a constantly updated average price movement. Now a rising moving average talks about a market that is moving in an upward direction, and a declining moving average talk about the one that is moving in a downward direction. Now first of all, let's get started on how to get the moving average. So simply click here and we move down to moving average. Now there's something you need to do here. You always leave the moving period always on 50 and the mode simple. These are MT4 I'm using to explain this video. So apply in low, okay, mode period 50 also. So this is it. Now like I mentioned, I said the moving average that is actually moving upward shows the price moving in an upward direction, and the one that is moving downward shows the price is moving in a downward direction. But first of all, you have to be able to understand what market structure is all about for you to be able to use the moving average. Now moving average actually is used by traders like technical analysis, like I said. So you need to be able to understand what the market structure is all about. Now if we take this for an example, we can see that this market structure here is actually, sorry, this here, let's use this as an example. This is actually bearish. So and now one thing I wanted to point out is whenever the moving average is actually on top of the price, it shows that the market is bearish. And once the moving average is in between price, like this here, it shows the market is actually not moving in a particular direction. Get this out. Sorry. Yeah, I explained the video in market structure where I talked about the first stages in which the market move. The market move from an accumulation stage here, which is an accumulation stage. It breaks out, like you can see here, the market break and retest and move to what advancing stage. Now in this advancing stage, the moving average is actually below the price and the price above the moving average. Like you can see, the price movements above, and in the declining stage, the price is always below the moving average here. Now once the price is above, you want to be looking for opportunities to buy. Now this takes us to the next segment. How do we know when to buy? How do we know when to buy using the moving average? Now once the price comes to the moving average like this shows an overextension, so you don't want to be buying here. And draw this out. Yeah, this shows an overextension, so you don't want to buy in here. You want to wait for price to come to the moving average like it did here. Sorry, like what happened here. So you want to wait for price to come to, let me zoom this out, to the moving average here. Now this is where you want to be getting your entry here to take price to the upside. Now the next opportunity we have is this. This was an overextension, price came to the moving average also here. Let's look for more opportunities. Same thing happened here, same thing happened here, and same thing happened here. Sorry, yeah, this was the last opportunity to take price to the upside. And what do we see? You want to be exiting your trade here. you want to be exiting your trade here, because why? The structure has changed here. Now in the bearish scenario, this is what happened. Now since we've exited the trade, we want to be looking for opportunities to sell. See what happened here. Price actually came to this moving average here, giving us an opportunity for us to what, look for sales and take market to what, to the downside. Now we've talked about when to enter, and let's talk about when to exit the trade. Now it's simple. You want to be exiting the trade at the zone where you know the price actually will actually come to that zone, somewhere here, somewhere here. So this will be the first target, entering at this zone here, entering at this zone here, and we want to be targeting the first order block here, the last order block that took price to the what, to the downside. So that would be the first exit for us taking our what, our profit from the market. Now this video is going to be a very short one, so there's something I want to really identify here. There's some few questions that I set aside for traders to ask themselves before using this analysis. Now the number one thing is, what time frame are you trading? What time frame are you trading? Now this is a 4 hours, and nobody should be entering the market under 4 hours. So you want to be going down to the lower time frame, 30 minutes, 15 minutes. As you can see, the moving average here in the 4 hours is showing a bearish move, and in the 30 minutes it shows that the market is about to go up. See, flattened out. If you go to the 15 minutes, you will see something like this. See, it all has its own different movement in each time frame. So which time frame are you trading? I always advise folks to do analysis in the higher time frame and go down to the lower time frame to look for potential entries. Now if we take a look at this, we know that the higher time frame, the market is actually bearish. The initial trend itself is actually bearish. This was just a retracement. So what we want to do is go down to the lower time frame and look for opportunities to sell, and not look for opportunities to what, to buy. Because why? The higher time frame is actually bearish. Now the next one is, how much are you willing to risk on each trade? Now it's simple. The first time I started trading, I always risked high because thinking I want to get a higher return. It doesn't work like that always, because I ended up blowing my account a lot of times. So I would advise folks to always risk 2% of their entire trading capital, because it gives you more opportunity. Let's say for an example, you have $100 account, $100 and trading account. So what you want to be doing is risking 2%, and that will be $2 on each trade. So if you want to lose, you have 50 times opportunity of trading before blowing up that account. And folks, it will be very difficult for you to blow an account 50 times just in a day, or maybe in a week or so, if you're using your trading strategy right. Now what market are you trading? This is odd USD. There are lots of market out there. Lots of market out there. So what you want to be doing is go to the initial, this USD Swiss francs. So you want to be trading the exact market you're supposed to be trading. See, this market was actually bearish. I was selling on this market. Though initial trend of this market is bullish, but I was just taking advantage of what was happening here. What was happening here? There was always opportunity. See, there was an opportunity to get involved in this chart. The first one was this. The second one was this. So I think the market is equally coming back to this moving average again. Let me take this out for us to look for opportunity to take price to the upside. So you need to understand and define the market you're trading. You need to define the market you're trading, and what are your conditions for trading. Your trading strategy. What's your condition? Now my own condition for trading is, I want to make sure I see the market come to the trend line or the moving average. And secondly, I want to make sure I see a market structure change indicator. Like in this case here, what I saw here was a head and uh, a head and a shoulder. This was the left side of the shoulder. This was the left side of the shoulder. This was the right side of the shoulder. And this was the head. So apparently we have a head on the left side and the right side of the shoulder. And guess what? I got an opportunity here. To enter the market and take price to the upside. So moving average, actually what I've noticed about it, it keeps you longer in a trade. Like you want to wait for that moving average to change before you actually look for opportunities to get out of that trade. So you want to be using trailing stop, like trading with Renner. That what he said in this one of his write-up I read earlier on. He said you want to be looking for opportunities to right price to the upside and moving your stop loss over time. Well, that works for you is fine, but I always love to take partials for my trade. Now, when do we enter? I've talked about that. And when do you exit your trade if you're wrong? Now, trading is a game of psychology. 70% psychology. You have to be able to understand and accept the fact that some of the times you might be wrong and get out of that trade or allow the market to hit your excel, because why? You've already calculated it before entering the trade. You shouldn't be placing a trade where you're not comfortable with. You should be sure of what you're doing before getting involved in the chart. And when do you exit? When you're right. So that's all for this video. Don't forget to subscribe, leave a comment section below in case you have any question for us to give attention to.